Hello, welcome to our recording of Module B, Professional Ethics. Take a moment to review our learning objectives for this module. So let's begin. Let's talk about general ethics. Ethics is the branch of philosophy which is the systematic study of reflective choice, of the standards of right and wrong by which it is to be guided, that is, good towards which may be ultimately directed. Let's review the key elements, which will be decision problems, moral principles, and consequences of the ethical choices that we make. So let's discuss an ethical problem. It's a situation where an individual like yourself might have to choose between alternative actions where the right choice isn't so clear and abstract, right? So an ethical problem is a situation that was described as one in which the alternative actions of the well-being of other individuals aren't always as reflective. So there's a conflict and you have to choose what to do. So the decision process for any ethical situation involves 5 steps where you have to define the facts and circumstances, identify the stakeholders, identify stakeholders' rights and obligations in general and to each other, identify alternatives and consequences, and lastly, choose hopefully the superior alternative with respect to those consequences. So you can review this ethical decision process. So let's talk about the philosophical principles of ethics. So we have the imperative principle, the utilitarian principle, which is an act and rule. We have the generalization and the virtual ethics. So let's start with the imperative principle. So this directs a decision maker to act according to the requirements of an ethical rule. So this is a very strict version and it maintains that a decision should be made without trying to reflect whether an action would create the greatest balance. So we're actually ignoring the balance of good over evil. So in this situation, ethics is an imperative sense as a function of our moral rules and principles, and it doesn't really involve any situation-specific calculations of consequences. So please keep that in mind. Now we have the principle of utilitarianism, and here we're actually looking at the consequences of action rather than the rules. Here, the criterion of producing the greater good is what's the main explicit part of our decision process. So in this particular act of utilitarianism, the center of attention is that individual and how they are affected by the specific circumstances. So again, it's the individual and how they are affected by those specific circumstances. So the rule utilitarian emphasizes now the rules, not the individual, but the rules for ethical behavior, which should still be maintained as the criterion for looking at the greater universal good. So make sure that you're aware of the act of utilitarianism and the rule of utilitarianism. Now let's talk about the generalization argument. So here it's a combination of imperative and utilitarian principles, and we are considering the consequences of a decision made by similar people under similar circumstances. So what would happen if everyone acted in this particular fashion? So if the answer to the question is that the consequences would be undesirable, then the conclusion in the way of that action is unethical and should obviously not be done or committed. Virtue ethics is by Aristotle, and here we're setting a self-focused standard. And here we're kind of instilling this intra-personal excellence, and we're trying to build our own character. And these virtues are honesty, openness, integrity, and our behavior would make us proud through widely reported measures. And while cheating would always be considered wrong, under this Kant's categorical imperative approach, the utilitarian virtual ethical approach, we would consider whether cheating would most align with the person that you as a student are trying to aspire to be. So it's virtue ethics in this situation. So here we have some ethical codes of conduct by the SEC, by the PCAOB, by the AICPA, and other societies of CPAs and state boards of accountancy. So now note the AICPA Code of Professional Conduct. Note that we have principles, which are ideal standards of ethical conduct. We have rules of conduct, which is the minimum standards of the ethical conduct as they are stated in these specific rules. We have interpretations of the rules that are done by the AICPA Division of Professional Ethics. And then we have ethical rulings, which is basically the published explanation and answers to any questions about the rules of conduct. So here you can see the AICPA Code of Conduct and their different parts. As you can see, there's a preface, which is applicable to all members. There's part 1, which are members in public practice, and part 2, which are members in business or private practice, and part 3, which are other members. And you see we have principles, rules, and interpretations. So now we have the applicability of this new AICPA Code of Ethics that is applicable to all CPAs, right? So those are including anybody that's unemployed and retired. Then we have CPAs in business, which adds integrity and objectivity, some general standards and compliance with these standards, and additional accounting principles. And then we add to that paradigm CPAs in public practice, which would include independence, fees, advertising, other forms of solicitation, some confidential information, and the form of the organization and their naming convention. So let's talk about the AICPA Code of Professional Conduct. So we have principles and rules of conduct, and these are some of the basic tenets. So here you should have responsibilities, that you should exercise professional and moral judgment. We have that the honor of the public trust should be adhered to in terms of our public interest. We should have integrity, objectivity, due care, and the scope and nature of our services. So while these principles are aspirational goals of behavior, the rules of conduct are enforceable ethical regulations that the CPA must follow. Now let's talk about independence. So the AICPA has an Independence Rule 1.200, and it states that a member in public practice shall be independent in the performance of their professional service as is required by the standards of the promulgated bodies designated by the council. So who is a covered member according to the AICPA? So these are all individuals participating in an engagement, an individual in a position to influence the engagement, a partner or a manager who provides non-attestation services to a client, a partner in the office where the engagement partner practices, the firm's benefit plan, and an entity that can be controlled by any person that is considered to be a member. So here is a great visualization of the comparison of the SEC, the Securities and Exchange Commission, and the AICPA, the American Institute of Certified Public Accountant, and their definitions of what an engagement team is and the chain of command. Note that the AICPA definition has defined a partner and a manager. And we continue with our comparison of the SEC and AICPA as to what is considered a covered person, a close family member, or an immediate family member. And now you have a nice visualization of the summary of the independence rules and their interpretations. What a covered member cannot do, what a covered member's immediate family cannot do, and what a covered member's close relatives cannot do. And more importantly, what a partner or a professional employee cannot undertake. Now we look at the conceptual framework of the AICPA Code of Conduct and their various steps. First, you want to identify threats. Secondly, you want to evaluate those threats. And third, probably most important, is you want to identify safeguards, whether they are existing or new safeguards to be implemented. So in April of 2006, the PEEC adopted the conceptual framework for the AICPA Independence Standards, which describes that the PEEC's risk-based approach to analyzing any type of independence issues that arise. So first and foremost, they're going to evaluate and identify threats to independence. Secondly, they're going to determine whether safeguards eliminate or sufficiently mitigate those threats. And lastly, you want to determine whether the independence has been impaired. So threats to an auditor's independence can exist in various formats, such as a familiarity threat, where a CPA has a close or long-standing relationship with a client. You can have an adverse interest threat, where the CPA is acting in opposition to the client, such as if they have a litigation claim. You may also have an undue influence threat, which is attempts to coerce or influence the CPA member. We may have a self-review threat, that the CPA is reviewing their own work. We may also have a financial self-interest threat, where CPAs have a financial relationship with the client. A management participation threat exists if the CPA is taking on the role of the client's management. And then we have an advocacy threat, where the CPA is promoting for the client's interest or position. So the AICPA Code of Professional Conduct, back to our independence rule of 1.200, applies to attestation engagements, which includes audits and reviews. And as it comes into term with financial relationships, there should be no direct financial interest. There should be no material indirect financial interest. There should be no material joint ventures with the client, any officers of the client, or directors or shareholders of the clients. And there should be loans that are only throughout the normal lending practices where collaterals are required. Outside of that, it is not allowed. As in terms of managerial relationships, the CPA cannot act as a promoter, an underwriter, or anything close to that as an employee. So there should be no decision-making authority according to the CPA. So then, for the purpose of independent, immediate family members have the same jurisdictions as the member. So whether you're a spouse equivalent, or a dependent, you also cannot have a direct financial interest or a material indirect financial interest, and you cannot hold a position of influence within the audit client. Also, a close relative, which includes all immediate family members, such as parents, siblings, or non-dependent children, they also cannot have ownership or control of an audit client. Employment within the client in an audit-sensitive situation is also not allowed. So now let's discuss some write-up services are allowed only if the client understands and accepts the statements as their own, the auditor does not assume a role of an employee or management, and no other relationship that impairs the auditor's integrity and objectivity. There is an exception that you cannot do write-up services for any public company client. So please take note of that. The exception is you cannot do write-up services for public company clients. Now let's talk about loans from financial institutions that are permitted if they're obtained prior to 2/5/2001, if they are obtained prior to the lender becoming a client, if the loan was sold to the audit client, if the loan was obtained before the CPA became a covered member, if the loans are on life insurance, or if they are fully collateralized by either cash deposits, loans, or leases. And as long as these loans are credit cards and cash advances in the amount of less than $10,000, that is permissible. So there is threatened litigation, and that impairs your independence if both management and the auditors are suing each other. But lawsuits from third parties, that is not the manager or the auditor, then that does not affect independence. So then we have, if you have a financial interest in a non-client, that may also impair your independence as an external auditor when that non-client has a financial interest in the client. So an auditor's independence depends on the auditors both having the mental state and also passing the appearance test. So that means that they have to have independence in fact and independence in appearance. So independence in fact is that the auditor has a mental state that is objective and lacks bias. And independence in appearance means that depending on whether a reasonable investor with knowledge of all relevant facts and circumstances can conclude that the auditor is not capable of exercising objective and impartial judgment. So again, independence in fact and appearance. So the SEC and the PCAOB rules prohibit or place restrictions on the following types of non-audit services that are provided to audit clients. So that means if you are doing the external audit of a client, you cannot do any appraisal or valuation services, actuarial services. You cannot perform management or internal audit functions. You can't do any of the HR, legal services, or expert services. And then you cannot do the taxes for key company executives, but you are allowed to be the external auditor of a public company and also do their taxes as the entity, but not for key company executives. So the SEC rules require that companies, not the auditors, disclose in their proxy statements delivered to their shareholders total audit fees, the total fees to the public accounting firm for both tax and any other advisory work, and whether the audit committee or board of directors considered the public accounting firm's advisory work to be compatible with the auditor's independence. And then they also have to disclose if more than 50%, which is the percentage of the audit hours performed by persons other than the principal auditor's full-time permanent employees. So now let's move on to the AICPA's Code of Professional Conduct that deals with integrity and objectivity, which is 1.100. Now, CPAs must remain free of conflicts of interest. A conflict of interest may exist when there is a significant relationship with a person, an entity, a product, or a service that can be viewed as impairing that member's objectivity. And then you do not knowingly misrepresent the facts. That would maintain your integrity and objectivity. You may not subordinate judgment to others. That means you as the external auditor have to maintain your professional judgment and your professional skepticism. And you do not knowingly make false or misleading entries on the company's financial records. If there is a disagreement concerning the preparation of the financial statements or any recording of transactions, you have to accept the supervisor's position if acceptable. So you have to either report it to a higher level other than the supervisor's position if it's not acceptable. And then you may also have to consider resigning if upper management will not take the appropriate action. So now let's move on to the AICPA's Code of Professional Conduct. And now we're going to talk about general standards, compliance with these standards, and the accounting principles rule. So you have to follow professional standards and their interpretations as mandated by the AICPA. You can only perform those services that can be completed with your professional competence. You always have to exercise due care, and you have to adequately plan and supervise all engagements. Additionally, you have to maintain sufficient relevant data that can afford a reasonable basis for all of your conclusions and recommendations, including your audit opinion and any of your audit work papers. So let's talk about discreditable rule 1.400. A member shall not commit an act discreditable to the profession, including discrimination, failure to follow GAS on a governmental audit, if you make false or misleading journal entries, if you fail to meet requirements of a governmental or regulatory body, if you fail to file your personal income tax return, and failure to disclose CPA examination questions or answers. Meaning that you have to file your tax return, and also if you take the CPA exam, you cannot disclose those questions or answers. Then let's talk about Rule 1.500, fees and other types of remuneration. So here we have contingent fees. Those are fees that are based on some type of finding or outcome. They are not permitted for any attestation engagements. and they are not contingent if they're fixed by the courts or based on the hours worked or services provided. Contingent fees are allowed for any non-attestation engagements, such as tax engagements, litigation support or forensic accounting, and consulting engagements. Now let's talk about commissions. Receiving fees if you recommend the products or service of clients or third parties, even if they're non-CPAs, is permitted for any non-attestation agreements if it is disclosed, but it is not permitted, it is prohibited for attestation engagements. Then let's talk about referral fees. That is when you're receiving fees for recommending the services of CPAs. That's permitted for any engagement as long as it is disclosed. Now let's talk about Rule 1.600, advertising and other forms of solicitation. So you are allowed to advertise and solicit new clients, and advertising cannot be false, misleading, or deceptive. So you can't create any unjustified expectations of favorable results. You cannot state the ability to influence third parties, and you cannot lowball or underestimate your engagement fees. Now let's talk about confidentiality information rule 1.700. So you as a CPA cannot disclose confidential information without the client's consent. There are a few exceptions that are noteworthy and you should know. You can disclose confidential information if it is to remain in compliance with the standards, if your work papers are subpoenaed by a court, and you're also allowed to disclose confidential information as part of a PCAOB peer or quality review. And also if there's an ethics violation for a state board of accountancy, then you are allowed to disclose confidential information. So please take note of these exceptions. Now let's talk about the form of organization and name rule, 1.800. So a firm can practice in any form permitted by the state, which would include an LLP, a limited liability partnership, or an LLC, a limited liability corporation. The name of the firm should not be misleading, and all partners of the firm must be CPAs or members of the AICPA if they are included in the firm's name. Let's talk about the International Ethics Standards Board for Accountants, IESBA. And their code states that it must be followed by auditors whenever an audit engagement is completed for any type of multinational client. So the importance has increased dramatically in recent years when we've had so many companies that have globalized and then people are conducting their audits. So there are some differences between the IESBA code and that of the AICPA Code of Ethics, but their codes are overall quite similar. So given that we have this increased importance of the international standards and the AICPA, then the AICPA has revised their code of conduct to kind of converge with these two codes. Now let's talk about regulation and quality control. So the self-regulatory disciplines are the AICPA and the state societies of the CPA, such as the PICPA. But then we have public regulation disciplines, which also include the state boards of accountancy, the SEC, which is the Securities and Exchange Commission, the PCAOB, the Public Company Accounting Oversight Board, and the all-time favorite, the IRS, the Internal Revenue Service. And here you see the AICPA joint trial boards in action and the number of cases that they have endured in the 2014 and 2013.